We're now on the brink of what could be the biggest shake-up to the Australian tax system since GST was introduced way back in the year 2000. Federal Treasurer Jim Chalmers has signalled that tax reform is not just on the agenda, but it's now one of his priorities. But what kind of reform are we talking about here? If you dig beneath the headlines, this isn't just about closing loopholes. It's about reshaping how wealth is going to be taxed and redistributed in a very different economic and demographic Australia moving forward. So whether you're a business owner, a property investor, a self-funded retiree, you may be directly in the firing line. And while Chalmers says this isn't about a tax grab, many of us know that when Canberra talks about fairness, it often means somebody else is going to foot a larger bill. So today, I want to unpack this with Ken Race, Director of Metropole Wealth Advisory, who's widely regarded as one of Australia's leading strategic property tax accountants. We're going to talk about what's been proposed, what the motives behind it are, and how you could possibly future-proof your wealth and estate plans amongst this uncertainty. So welcome to another episode of the Michael Yardney podcast, where we help investors gain clarity amongst the confusion of all the mixed messages so that they can develop financial freedom through strategic property investments and also smart money management. Let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Welcome, Ken. Now, as I mentioned in the introduction, the Federal Treasurer Jim Chalmers has signalled that tax reform is not just on the agenda, Ken, but it's actually a priority.
Yes, and once you understand the mechanics behind that statement, you realise it must be, it has to be.
Well, Jim Chalmers says it's not about a tax grab. He said many of us, it's just going to be a bit fairer. It's going to be fairness. But Ken, you and I have been around long enough to know that if somebody's going to pay less tax to make it fairer, somebody else is going to foot the bill and pay more tax.
That's right, because there's just so much money that can be collected, and if they collect more, that means one group has to pay more. And if you go back to the fundamentals of why this is even on the table.
Yes, please.
We're well and truly entrenched in what I call a debt tsunami. So there's a shrinking tax base. So we all know the parable of the frog, cold water, a bit warmer, a bit hotter, and then they don't realise they've been scalded. Well, we've been massively hit with this shock of this debt tsunami, which is why we've been in a per capita recession for 2 years. And there was a slight reprieve in December where we broke the 21 consecutive month record. But in March, we're back up again. So I think the government has to look at why and how. And when we look at the future budget estimates, Australia is going to have a gross debt well into the next 40 years, which is double what a normal person takes to pay off their home.
Yes.
So they've got to do something dramatic, and it can't just be taxing a little bit higher the stuff they're already taxing, because there just isn't enough, and it'll impact, I think, their base too much. So they've got to start thinking, can I say, laterally and outside of the box. So this is like tax planning in the negative sense. Let's think of smart ways to increase taxes as opposed to the Kerry Packer method of paying the appropriate tax.
Well, for those who don't know, Kerry Packer, many years ago, at the time Australia's richest man, businessman, the late Kerry Packer, he said that he pays the minimal tax he can. He doesn't cheat. He doesn't want to give more tax to the government because he thinks he can use it better, his money, than the government can. But we know that the government has got a significant debt bill, and the word the Treasurer so far used is significant tax reforms. Now, before we go any further, there's always a disclaimer at the end of the show, but we are going to talk a bit about tax, and I hope you're going to give us some hints about what to do, Ken. So this is not specific advice for anybody. But later on, if you want to understand a bit more about how you can get Ken's personal thoughts, I'll let you know how to be in contact with Ken. But this is firstly general information, and secondly, I guess, supposition, speculation, because we don't really even know what they're going to talk about. But I think what you're already saying, Ken, is that it's not going to be just a tweak around the edges, is it?
It can't be. The governments of all persuasions, and certainly the current one, are backing themselves into a corner. Over the next 5 years, we're seeing spending increase by over $237 billion. The gross debt is going to increase a further $200 billion. So we're seeing massive increases in spending and therefore debt, not commensurate with the increases in revenue. So the government is almost saying the pie is shrinking and we're going to actually extract this, blood out of the stone that we always say you can't. And that's why they have to think of alternate ways to generate revenue to pay for their expenditure promises.
So, Ken, you're talking about Australia's debt burden. Let's just put it into context. How much is it and what's it costing us?
Yeah, and I think that debt burden is really what's driving this government of thinking about ways to increase its revenue base, which is taxes. So if we look at the most recent budget, they're talking about a gross debt of over $1.2 billion in Australia. That's increased more than 100% in 5 years. 100%, 105%.
Wow.
So the interest on that is, roughly $30 billion, give or take, depending on a year. And when you look at how much is spent on health, on education, NDIS, they spend $50 billion. Age pension, 40 odd billion. So the interest bill is almost as much as what they spend on NDIS and age pension. And again, maybe half what they spend on, NDIS and age pension, and about half what the federal government spends on the hospitals and education. So
it's not productive, is it?
It's not productive. And having such large unproductive debt, given that it's not nation-building debt in the main, I think that has a potential impact on our credit rating. And if our credit rating slides, then the interest bill to the federal government increases. But can I say more critically, the interest rate that everybody else pays will grow because no one can have a better interest rate than the federal government because the federal government can always increase taxes. So interest bill on our debt is critical, and therefore they're managing it by looking at ways to reduce that debt. And if we're going to have gross debt over the next 40 years, as I previously said, that's twice the time it takes the average Australian to pay down their home debt. They've got to do something. And if they don't, they will then have to do something about what they spend money on. Without being a political statement, there's a lot of discussion at the moment about increasing our budget on defence.
Yes.
Well, where's the money for that?
Yes.
That's one of the prime reasons the federal government is just absolutely putting their foot on the brake.
Interesting.
Because they can't find money for defence, but they're going to try and find money for NDIS, for dentists, for hospitals, because everybody sees that every day of the week.
Now, Ken, I think even more than that, though, we know that that's another reason that there's the big Australia policy from the current government, bringing in more migrants at working age, so not young people who go to school and cost the system money, or older people who would eventually use up the healthcare system and the pension, but can't see them lowering immigration either, can you?
No, they need that to at least keep the per capita recession down to a minimum, as opposed to a full-blown economic recession. Because we're not making more, but we're bringing in more people, so there's more people to divide the pie, and that's why the mum and dad households around Australia are feeling the pinch, because we're asked to spread the same amount of money over more people. And that is a recipe for disaster.
Well, again, we don't know exactly what's in the sights of the government, but on the other hand, they say they're going to look at a whole lot of things. One of the things that's been hinted is he's not going to change GST. Now, I'm not an economist. I would have thought increasing the GST to something like 15% would actually, much like the rest of the world, would actually make some sense, because in my mind, is going to be quite a magic trick to efficiently bring in more tax without changing the GST.
Well, I think one thing they can look at before increasing the actual rate from 10 to 15 on the same basket of goods, there's a whole bunch of economic activity which doesn't have GST applied. When you
Of
think
course.
when you think of the money that washes around this country, there's no GST on any of that. So the most modicum of charge on using money that I think won't really impact a lot of the average households, but it will actually bring in more money. So that's one way of, if you like,
Interesting.
increasing the intake without actually making the average Australian have to stick their hand in their pocket more or to
And
any
increasing the
significant effect.
GST, sorry, no, we were talking, Ken, increasing the GST also hits the black economy, the cash economy, because those people have to spend their money as well. Now, we don't know exactly what's in the sights of the government, but a recent report in the Australian Financial Review suggested family trusts, electric vehicles, and some other broader tax wealth ideas. Maybe you could just talk us through those.
Yeah. When I talk about electric vehicles, I go one step behind and I say currently the internal combustion engine predominantly uses petroleum products, petrol. And there is significant billions of dollars generated out of petroleum excises. And in fact, the mineral sector of the Australian economy generates about $75 billion in royalties and taxes. So as we are moving away from this carbon dependent economy, where's that $75 billion going to be? Where's the gap going to be filled from?
Point.
So not only are we not currently generating revenue from EVs, we're actually reducing our intake from the internal combustion engine. So we have to say enough is enough. If people are supporting this carbon neutral economy, they have EVs, then they've got to pay or services have to suffer. So I think that's going to be an area that is low hanging fruit, but a lot of people will object. Family trust is a funny one because I've got a slightly different opinion. A family trust is an entity where revenue and expenses are paid, but you can't leave the money in there.
It's really just a pass-through vehicle in some ways, isn't it?
Correct. So if you don't pay it out, then it's taxed at the highest marginal tax rate. So it gets passed out and then it gets into somebody's hands who pays their marginal tax rate.
Yes.
So it's not as if the money's hidden or can't be caught. So I think that's more an emotional thing that a lot of people are seeing trust as a way of hiding money. And it's certainly not hiding money, but it may distribute it in the most tax effective way.
Now, again, we're not suggesting anyone goes and changes anything yet in anticipation of that. But if there are some changes to trusts, that would be a huge impact on small business owners, because many business owners operate in trusts, not just high net worth individuals, but a lot of ordinary Australians have trusts as well. And it will make a difference to intergenerational wealth structures, won't it?
It will. I mean, for business owners, they can act as a sole trader, they can work through a company, and they can work through a trust. So that at the very end of the tax trail, a company or trust isn't too dissimilar. So because a company is taxed, it can retain its money, unlike a trust, but it eventually pays it out as a dividend to the shareholders. And again, the shareholders will pay any top-up taxes, but they get the benefits of the franking credits. And without being too technical, the tax that the recipient of a dividend pays is the difference between what the company has already paid and what their marginal tax rate is. So whereas in a trust, the money flows through and you pay your full marginal tax rate at the moment. So if they're going to tax trusts, then, are they going to apply the franking credits the same as they do in a company? That means you can leave money in a trust. So there are some structures at the moment that operate as trusts that actually get taxed as companies. And they're those large institutional unit trusts that hold properties or other large assets.
Now, I'm sure there's lots of people in the Treasurer's ear. The Grattan Institute has come up with some ideas of taxing wealth rather than work. That's not something that we've done in Australia before. The notion was, I think, that baby boomers had it too good. And so therefore they may look at superannuation concessions, death taxes, inherited wealth taxes, capital gains tax on death. Boy, negative gearing. Now, that'll be interesting if they bring all that in as well. Are we slowly witnessing an erosion of the intergenerational wealth planning tools that Australians have used for decades, or for more than decades, really?
I think that's one-dimensional because we see true wealth. So when we talk about an economy, it's true wealth, it's gross domestic product, what it can produce. And if you produce more than you consume, therefore you're exporting more, you're actually generating money that is not actually a tax on the local individual. And the successful economies have used labor, resources, and entrepreneurship. And that's why some of the communist countries failed, because they didn't have that entrepreneurial in.
Yes, yes.
So if you're going to start taxing wealth, you're taxing entrepreneurialism, which means that you're going to have people less likely to want to generate wealth, which employs people, which pays taxes, which supports social security, etc. And those people with great ideas will move offshore.
Yes.
So we're actually going to cut off our nose to spite our face.
We're hearing a lot about people moving to Dubai and Middle Eastern countries where the tax system is more conducive to being an entrepreneur.
Correct. And so when we look at baby boomers had it so good, they're actually created wealth that they're going to hand down, and they'll hand it down to their children or their grandchildren. And it depends what they're trying to do with their money, which one they'll send it to. But they will then do something with that money. They will go into business. They will invest it. They will pay the taxes. So inheritance tax, I think, is a sleeping dog that is really going to turn into a wolf and bite the hand that feeds them. Because even some of those Scandinavian countries, which tax people through the nose, got rid of inheritance tax decades and decades ago because they saw it really wasn't an efficient way to manage an economy.
So are we actually talking about fixing inefficiencies, or is there an underlying redistribution of wealth hidden under all this?
It's got to be the latter, because if we see, in my opinion, the primary aim of this is to reduce Australia's net debt and have more money to spend money on whatever the government wants to spend money on. And therefore, it can't distribute what it's already got. They've actually got to create a bigger pool of taxed money to pay for their grant scheme. Now, if these grant schemes took into account major infrastructure, productivity improvements, nation building exercises, you could see the future could actually benefit from that. But a lot of the money is being spent on things that need to be paid for in the current year. And therefore, they're borrowing money to pay for the current. They're not borrowing money to pay for the future. And that's why I think, that's why I think they've got to find new avenues of money to pay for these things, because there isn't enough in the current pool to pay for all this.
Well, obviously the government's going to have pressures from the business side of things, from the ACTU, a lot of other people, and they're telling them to act. But is this going to happen before the next election? Some of the things I heard were that they're going to take this as policies to the next election. On the other hand, you hear they say, well, we've got a sufficient mandate now. We don't need to take it to the populace again.
Look, I mean, that was the argument with taxing capital growth in super funds for the larger super funds. They say we talked about it, but it was taken to Parliament numerous times and rejected by Parliament.
Mm.
And then they stopped talking about it. And now they bring it up again. They say, oh, but we've been talking about it before. Well, it had been squashed before. So I think, unlike Howard, who had the spine, I was going to use another word,
yes,
to actually talk about GST for years before, where people actually understood it better. So I think people will be nervous because they won't know what's happening. So unfortunately, many people, I think, will change the structures they've got. If they've got trusts, if they've got super, if they've got other strategies, they're going to start thinking, is it now time to change? But change to what and for how long? So I think you've really got to talk to people who understand these topics to see whether your particular circumstances warrant a change and to what. So coming back to your question, will things be implemented before the next election? I think some minor things will be. I think some bigger things, I think it'd be a very courageous government who introduces something materially new without having ever spoken about it publicly, haven't gone through an election.
Well, that brings us to the point that if there is going to be changes to whether it's franking credits, capital gains tax, trusts, super, is there anything one can do now? Should families, business people, investors have any tax planning strategies before any changes are legislated?
Look, I think it's always worthwhile to re-look at your structuring, the same as you should keep track of your wealth position. So we see many new clients who are in these structures and they've been in them for years, but we find that they're not actually being operated efficiently or the most tax effectively. So I used to use an analogy. If you were given a Formula One car, you probably couldn't get it off the starting line because you've got to be taught how to use it and drive it. And it's the same with a lot of trusts and different ways to utilize companies and superannuation. So just having a particular strategy and structure doesn't mean it's being optimized. And therefore,
that's what your team at Metropole Wealth Advisory specialise in. I know that since our wealth retreat, where we had a lot of very high net worth clients, some very significant business people and entrepreneurs, they came along, they got your advice. And even though in the past they'd had advice from top tier accounting companies and legal companies, it was worth getting a second opinion because you found ways of just improving the way they use their current systems.
Correct. It's tweaking it. And that's because we take this holistic view where we just don't look at one particular focus, accounting or tax or estate planning or super. We bring it under a holistic umbrella, so to speak, to make sure the left hand knows what the right hand is doing. And that's where a lot of money is lost.
That's a really important point, Ken, because the accountants look at compliance and the solicitors look more at legal aspects and asset protection. And then there's the property and finance people who talk about wealth creation, but they're not always speaking to each other, are they?
Correct. So we sort of form a bridge between that profession and the client. And because we actually know the answers from the other side, we can actually debate it, I think, a lot more efficiently.
Well, I'm going to leave a link in the show notes to how to make an appointment to have a chat with you and your team at Metropole Wealth Advisory, because you don't want to be their accountant. That's not what you do, even though you're an accountant. But it's actually to do. Interestingly, somebody I saw yesterday, a high net worth client, a very, very successful property developer, who came up with the words, and you used them years ago, I want a health check on am I doing things right? And even in my simplistic view, I saw some of the things he initially was doing could be improved a lot. So it is a sort of a health check, isn't it?
It is a financial health check.
Sure. So it'll be interesting to see what the government is going to do. When are they going to start talking about this? Have there any timelines been laid out yet?
Not specifically, other than bringing it up that they've got other reports that have been done over the years that, should we use something out of a Henry report or something out of someone else's report? But there again, I think they've got to come back to basics because a lot of those reports, again, were very one-dimensional. They looked at one thing or another.
Yeah.
The way I'm interpreting the words, which is a dangerous thing to do out of the Treasurer and even the Prime Minister at the moment, is they're looking for a new pot of gold that hasn't been tapped.
Mm-hmm.
And that means they've got to spread that net a lot wider and have a look at those unintended consequences because that always crops up. And we saw something recently, couple of elections ago, let's get rid of franking credits. So at the end of the hoo-ha, it was except for the big industry funds and obviously the big retail funds. And that's because they worked out because franking credits in those super funds were nowhere near as beneficial to the member as they are to someone in a self-managed super fund or someone as an individual. So we did a lot of work with clients to see how that would impact it if it went through. But at the end of the day, Australia is one of the few countries that actually has the concept of franking credits, which is pretty good. You only get taxed once on the same dollar.
Yes.
But
seems fair.
It seems fair. That's an area I think that will be looked at. I hope they don't asset pick when they're looking at taxes. And by that I mean, if we pick negative gearing is a concept that says, if I believe long term I'm going to make money out of a particular business, and property is a business if we talk about property.
Yeah.
If I believe I will make money out of that property long term, I can claim the benefits of any losses at the beginning because the ATO knows it's going to claw the money back. And all businesses use this technique when they have multidisciplined businesses or products. I mean, if you introduce a new product, you know you're going to not necessarily make a lot of money in the first few years. You could lose money, but it's funded by the other more mature products. So I find it incongruous that they're going to say, we'll get negative gearing off the table for one asset type, but leave it in place for every other one.
Yes.
So I think if they're going to be picking new taxes, they apply it more broadly. And I think that means that it'll impact more people and therefore there'll be a better debate as to its appropriateness.
Well, that was a really interesting, insightful conversation, Ken. So if I heard correctly, what you're saying is Jim Chalmers' upcoming tax review is actually going to potentially be a significant shift in how Australians are going to be taxed for decades. And while the government says it's not about raising more taxes, it certainly looks like they're gearing up to change how wealth is structured, managed and passed on, whether it's family trust, superannuation, property or broader wealth strategies. I think this review could have significant implications for investors. A lot of property investors listen to and watch this show, business owners, even self-funded retirees. And I guess if history is any guide, by the time these changes are formally announced, the window to respond positively may have already been closed. So I guess what I heard you say is now's the time not to be complacent. If you've built substantial assets or you're passing your assets on to future generations, it's worth reviewing your financial structures with somebody who really understands how tax and estate planning intersects with property and wealth creation. So thanks for that clarity. And I think if somebody felt, hey, this could affect me, they really should reach out to you and your team at Metropole Wealth Advisory and to put themselves in the position to understand the implications and react smartly. So I'll leave a link in the show notes or go to metropole.com.au. And hey, if you listen to this, watch this with Ken and me, and you found it useful, please pass this show on to somebody else. You'll know somebody who needs this similar information to protect themselves. And of course, if you don't currently subscribe or follow the show, click the subscribe button or follow button on whichever podcast or video app you're watching us on so that you get the regular inputs. Ken, I want to in a couple of weeks get together with you and start a new series of macro insights. You've just shown your level of perspective. So really what I'd like to do is look at the big picture news and how it's going to affect property, the economy and people's money. So I look forward to that chat in a couple of weeks, Ken.
Yeah, that's going to be a showstopper. I'm looking forward to it as well.
Thank you, Ken. Now, regular viewers or listeners to this show know that we've been running a property trivia quiz each show where I ask you a question and you leave your answers at propertytrivia.com.au. Now, if you know the answer to this one, I'm going to give you a really easy one this time. You've got a chance to win one of my top-selling books, How to Grow a Multi-Million-Dollar Property Portfolio in Your Spare Time. 3 people are going to win a book this week. Everyone else is going to get a report, and I swap around the report so that to encourage you to enter more often. Even if you're listening to this as an old show, just go to propertytrivia.com.au, leave us your answer because it will still count. So this is a reasonably easy one because some of the questions recently were a little bit harder. And the question is, what does RBA stand for the organisation that sets Australia's official cash rate? Now, come on, you know the answer to that. What does RBA stand for? Go to propertytrivia.com.au, leave us your answer, get a report, and you've got a chance to win one of my books, How to Grow a Multi-Million-Dollar Property Portfolio, a real book, a hard copy book.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I want to share with you a message I learned early in the piece from one of my mentors, I think it was Dan Kennedy who told me that the world doesn't owe you anything. And as I got older, wiser, I think this is a real problem that's going on in the world today. I feel many young people walk around with a general sense of entitlement, and that can be damaging. Now, this truth might hurt, but the world doesn't owe you anything, as I was taught years ago by my mentor. I know it may sound harsh, but accepting the truth is essential in maximizing your personal development and your financial situation. So the sooner you take responsibility for yourself and stop relying on others, like I know your employer or the government to take care of you, the sooner you take control of your own financial future. Depending on your background and perspective, I know this concept could sound scary. I'll tell you, it's not nearly as scary as hoping that your employer is going to show you loyalty when the market changes, or that you're going to be paid what you're worth if the business doesn't go well. That's a mirage. It's not secure. Job security isn't really there anymore, is it? So one of the most powerful things that will happen when you accept that no one's going to take care of you financially is that you become more motivated to do something. You begin to look closer at your financial situation. You start to notice your budget more, how much you earn, how much you spend, how much you pay in taxes, what your expenses are. You start to take responsibility. I know this was the case in my life years ago, and I hope you start to think the same way too. Now, why have we got this sense of entitlement? I think this new sense of entitlement is partly because, I know I'm going to offend some people, but the cushy way in which children have been raised in the last few decades, when you consider that we live in what's been regularly ranked as the wealthiest country in the world, it was surprising to find that half of our nation gets a government benefit of some sort or another. I'm all for helping those with a genuine need. I really believe it's our role to give them a hand up, and Pam and I give a lot to charity. I've always supported charities for the needy, but it seems that today there are more people not doing their share, waiting for those that do their share to provide for them. In essence, they feel the world owes them something. In fact, many people operate on the assumption that the world owes them a hot meal, a bed to sleep in, shoes, smartphones, and anything else they want, simply because we exist. I also know that today some people don't want to work, and I know a couple of those people, if they do work, they don't want to work too hard, nor do they want to work in jobs that are beneath them or aside from their personal interests. They call me old-fashioned, but I see children getting trophies just for showing up, lest we hurt somebody's feelings by admitting one child's better than another. I know it's changed the way we bring up kids and grandkids. Children aren't allowed to fail. We can't separate the intelligent from the less intelligent, and we're forced to make sure that every person fits into the same mold in life. Now, that's not to judge the worth of people. I'm not suggesting that at all. We're all important and we're all worthy, but the world has a bullying problem that can no longer be solved by playground brawls. In many ways, many people today are living their lives as victims. They're giving up their right to choose, to succeed and create their own destiny by sitting back and waiting for scrappy handouts that are left behind. And then with audacity, these same people feel they've got the right to complain about what they were given. The problem of entitlement is not one that's going to go away anytime soon. The truth is that people need to realize that it is we who owe the world. We owe the world our talents. We owe the world our skill. We owe the world our ability to take care of our planet. We owe the world our efforts to make the planet a happier, safer place. And in my mind, until each and every person can get together and realize that within each of us, big and small, black and white, male or female, rich or poor. Now, please excuse me if I use some of those words that may offend somebody. I'm suggesting we're talking about everybody. Within each of us lies a responsibility to the world. Until we recognize that the responsibility is within us, I guess things are going to get a little bit worse. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. And I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast. We ain't demographics decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Well, just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?